I'm Emily Coaster, and welcome to another edition of the Commodities Institute podcast. Today is February 24th, 2026, and we have a lot to unpack across oil, metals, agriculture, power markets, and global trade flows. This is one of those moments where individual headlines might look disconnected, but when you slow down and listen carefully, they're all telling a single story about how fragile and how interconnected commodity markets have become. Let me start in the oil market. One of the most consequential developments this week is Iraq's decision to enter exclusive talks with Chevron over the West Qurna 2 oil field. This is not just another upstream negotiation. West Qurna 2 is one of the largest oil fields on the planet, accounting for roughly 0.5% of global supply and nearly 10% of Iraq's total output. What makes this deal remarkable is how it came about. The field had been operated by Lukoil, but United States sanctions linked to the war in Ukraine made it increasingly difficult for the Russian firm to continue operating. Iraq responded by nationalizing the asset, temporarily transferring it to the state-owned Basra Oil Company and now opening the door for Chevron to step in. Chevron has secured exclusive negotiation rights for 1 year, but this is not a done deal. The Iraqi cabinet still needs to sign off, and approvals are also required from the United States Office of Foreign Assets Control. Behind the scenes, Chevron has been pushing hard for better economic terms, arguing that returns on West Qurna need to improve before it commits capital. If this goes through, it would mark a major expansion of Chevron's footprint in Iraq, and another example of how geopolitics is reshaping who controls critical energy infrastructure. Now, let's talk prices, because oil is once again sending uncomfortable signals to central bankers. Since mid-2024, oil had been a disinflationary, quietly helping to cool headline inflation. That dynamic is now fading fast. Brent and West Texas Intermediate are trading at their highest levels in nearly 7 months, with gains of roughly 15 to 20% so far this year. The critical point here is base effects. A year ago, oil prices were sharply lower. Today, Brent is only about 2% cheaper than it was 12 months ago, compared with a 30% year-on-year drop at the start of January. That means oil is on the verge of flipping from a deflationary drag to an inflationary driver. This matters because transportation and motor fuel account for roughly 16% of the United States Consumer Price Index basket, second only to shelter. Even modest, sustained increases in oil prices ripple through supply chains. Research suggests that a permanent 10% rise in oil prices can lift headline inflation by several tenths of a percentage point. That might not sound dramatic, but when inflation is already hovering around 3%, it can be enough to change the tone at the Federal Reserve. We're not talking about a 1970s-style oil shock. Global production is running at around 106 million barrels per day, and there is still an underlying oversupply. But geopolitical risk is back in the price. Roughly 20% of global oil flows through the Strait of Hormuz, and even a low-probability conflict involving Iran commands a risk premium. Policymakers may have hoped oil was no longer their problem. That assumption is being tested. From oil, I want to pivot to agriculture, where timing is everything. In Brazil, farmers have harvested only about 30% of the current soybean crop, the slowest pace since the 2020 to 2021 season. Delayed planting, longer crop cycles, and persistent rainfall are all to blame. There is also growing concern about potential crop losses in Rio Grande do Sul if rains fail to materialize. At the same time, Brazil's second corn crop planting is running well behind last year, and the first corn harvest is also lagging. These delays matter because Brazil is such a dominant supplier to global grain markets. Any hiccup there tightens availability elsewhere, even if headline prices have been relatively subdued. Contrast that with Ukraine, where expectations for the next season are improving. Wheat and corn output are both forecast to rise in the 2025 to 2026 marketing year, driven by expanded planting areas. Exports are expected to increase as well. It's a reminder that global agriculture rarely moves in unison. Weather, logistics, and geopolitics create regional winners and losers, often at the same time. Let's move into metals, because this is where one of the most important long-term shifts is unfolding. Copper has quietly overtaken iron ore as the key profit driver for the world's largest miners. At BHP Group, copper now accounts for just over half of operating earnings. At Rio Tinto, copper's contribution has doubled year on year. Prices tell part of the story. Copper has risen nearly 60% since its lows last April, reflecting supply disruptions, stockpiling, and uncertainty around trade policy. But the deeper driver is structural. Electrification, renewable power, and electric vehicles all require vast amounts of copper. Even conservative estimates suggest global demand could double by mid-century. The problem is supply. New copper deposits are expensive and slow to develop. That's why BHP and Rio tried and failed to acquire major copper assets through large-scale mergers. Valuation disagreements killed those deals, and in hindsight, sellers were probably right to hold out. The implication is that miners may now have to pay much higher premiums for copper assets or take on the risk of developing new projects from scratch. Iron ore, by contrast, faces a more uncertain future. China's steel output has likely peaked, and new supply from projects like Simandou in Guinea is coming online. Prices have drifted below $100 per tonne, squeezing margins and, in Australia's case, threatening government revenue. Speaking of Australia, officials there are closely watching negotiations between iron ore miners and China's state-backed buyer, China Minerals Resources Group. A $10 move in iron ore prices can swing hundreds of millions of Australian dollars in tax receipts. This is a vivid example of how commodity prices feed directly into national budgets, not just corporate balance sheets. Before I wrap up, I want to touch on power and trade flows. In the United States, a surprising number of coal and gas power plants scheduled for retirement may stay online longer. Electricity demand is rising, driven in part by data centers and artificial intelligence, and grid reliability concerns are forcing policymakers to delay closures. Coal remains a dependable baseload source, but it comes with high environmental costs. This tension between reliability and decarbonisation is far from resolved. In Europe and the Americas, Enel is doubling down on renewables and grids, while warning that regulatory changes could weigh on profits. And in Africa, Uganda is exploring a new railway link to Tanzania's port of Dar es Salaam, potentially opening alternative export routes for minerals and reshaping regional dry freight patterns. When you step back, the common thread across all these stories is transition under pressure. Energy systems are changing, but not fast enough to eliminate old dependencies. Supply chains are diversifying, but geopolitics keeps getting in the way. Prices are sending mixed signals, and policymakers are once again being reminded that commodities still matter. That's all for today's episode. If you found this episode valuable, be sure to subscribe, share, and leave a review.